Welcome back to the channel, where we dive deep into the world of finance and investment strategies. Today, we're tackling a topic that many of you have been curious about: real estate investment versus stock investment. Both avenues offer unique opportunities and challenges, and understanding the nuances between them can significantly impact your financial journey. So let's explore these options together, and I encourage you to reflect on which might align better with your personal goals. Let's start by discussing liquidity. When we talk about liquidity, we're referring to how quickly an asset can be converted into cash without significantly impacting its value. In the realm of stock investments, liquidity is one of its standout features. Stocks can be bought and sold on exchanges at any time during trading hours, often within seconds. This means that if you need cash quickly, stocks can provide that flexibility. On the other hand, real estate investments lack this kind of liquidity. Selling a property is not only time-consuming, but can also incur significant costs related to commissions, repairs, and other expenses. It may take weeks or even months to close a sale, making real estate a much less liquid investment compared to stocks. So if you foresee needing quick access to cash, consider how this factor plays into your decision-making process. Next, let's talk about accessibility. Investing in stocks is often viewed as more accessible for the average investor. With just a few clicks on an online platform, anyone can begin investing in the stock market with relatively small amounts of money. There are also numerous resources available: educational videos, webinars, and analysis tools that cater to novice investors. In contrast, entering the real estate market usually requires a larger upfront investment. Not only do you need sufficient capital for a down payment, but you also need to account for additional costs, like property taxes and maintenance fees. However, many people find real estate appealing because it feels tangible. You can see and touch the property you're investing in. But keep in mind that while stocks may require less initial capital and effort to start investing, successful real estate investment demands thorough research and due diligence. Now, let's turn our attention to profitability. Historically speaking, both asset classes have shown substantial returns over the long term. The stock market has averaged around 7% annual returns after inflation over many decades, while real estate can also yield strong returns through appreciation and rental income. However, it's essential to consider the context of these returns. Stocks are subject to market volatility. Prices can fluctuate dramatically based on economic conditions or investor sentiment. Conversely, real estate tends to appreciate more steadily over time, but can also face downturns, especially during economic recessions when property values may decrease. The rental market can also be influenced by factors such as location and local economic conditions. When assessing profitability in these two areas, think about your investment timeline and risk tolerance. Stocks may offer higher potential returns but come with increased risk. Real estate might provide stability but could limit your growth potential. Speaking of risk, let's delve deeper into this vital aspect of investing. Stocks are often seen as riskier due to their inherent volatility. Their prices can swing wildly in response to news events or market trends. However, this volatility also opens doors for potentially high rewards if timed correctly. Real estate investments generally present different types of risks. Market fluctuations can affect property values. Changes in interest rates can influence mortgage costs. Tenant issues may lead to vacancies or property damage. These are all scenarios that real estate investors must navigate carefully. So how do you assess your own risk tolerance? Consider whether you're comfortable with fluctuations in value or if you prefer something more stable but potentially slower growing like real estate. Finally, let's reflect on the psychological factors at play in both investment strategies. Investing in stocks may feel more abstract for some people. Watching numbers go up and down on a screen can induce anxiety for those not accustomed to market dynamics. Meanwhile, owning property often invokes a sense of control. It's an asset you can manage directly. However, that sense of control comes with responsibilities. Maintenance issues and dealing with tenants can add stress to the ownership experience. Understanding how you respond emotionally to different types of investments will help inform your choices. As we wrap up today's discussion on real estate investment versus stock investment, it's clear that both avenues come with their own sets of advantages and challenges. Your choice should ultimately depend on your financial goals, risk tolerance, investment timeline, and personal preferences. I invite you to share your thoughts in the comments below. Are you leaning towards one option over the other? What factors resonate most with you as you consider your investment strategy? Your insights could help others navigating this important decision as well. If you found value in today's video, please give it a thumbs up and subscribe for more expert insights into the world of finance. Until next time, happy investing!